Hello, this is Mr. Goldberg, and welcome to Exchange Traded Fund. And this is part of the Financial Securities course, which is being held at Martin Grove Collegiate, if there's no, global pandemic happening. Anyways, not to make light of it, let's get into what these things are, another investment type for you. So what we are going to do is talk about a whole bunch of things today. We're going to start with indexing, then go on to what an ETF actually is, advantages, disadvantages. Then we'll look at asset mix and how you can accomplish this concept with a nice blend of ETFs, and you can do it very easily as well. And then we'll look at how you actually make an ETF investment. And I'll give you a very simple strategy, the couch potato method. And it sounds simple because it's got that great name, that couch potato name. Okay, so you might ask yourself, well, before we get into all this, what is an index? Well, an index is basically a benchmark that is a measurement of something that's out there. It sort of standardizes what's happening in any field, but there are indexes or indices for the weather. There's indices for all, it's in the scientific realm, but it's also in the world of finance, and it's in there a lot. You see it on the news every day. So what happens is you take the stock market and you squish all that stock market activity, that millions and billions of dollars worth of trade and all these transactions and so on, take all that and squish it down into a single number, and that's your index. So examples of common indices out there, or indexes, I like to say indices, anyways, are the S&P TSX Composite Index, and it's, I guess, S&P comes up with the index, or at least manages that index. And there's also a TSX Canadian Bond Index, and these are Canadian examples. We are in Canada, and so give me a nice source there. Great source. The Investor Education Fund isn't really there anymore. It's now getsmarteraboutmoney.ca, and anything financial, any age, great source of information. And I have a lot of my information from this source as well. So Investor Education Fund, Get Smarter About Money, same thing. You'll see Get Smarter later on. So indexes, I just did it. Indices are based on the number 100, or sometimes it's the number 1000, or often it's the number 1000. And that's your benchmark number. So when you see that TSX number, for example, that TSX Composite Index, that number was 1,000 as of 1972. So the first index was created by Charles Dow. Everyone thinks, the Dow Jones Industrial Average, it's two guys. It's actually Charles Dow, who worked for the Jones Company. And he created this way back in 1896. And that tracks the top 30 stocks on the New York Stock Exchange. And today, there are thousands and thousands of indices out there. All right, so let's get into what an ETF is. An exchange traded fund is a fund that chooses investments based on a market index or a sector, but that sector also has an index. The ETFs trade on a stock exchange, so you buy them like a stock. They have symbols, and they're not actively managed. So their costs tend to be lower than that of mutual funds. We just did mutual funds last time around. So mutual funds are often what are called actively managed. With ETFs, they are what's called passively managed. So it's sort of the opposite of actively managed. And because of that, there's less trading involved and therefore less fees involved. So your MERs tend to be lower, your management expense ratios. The ETFs themselves follow one particular index. They specialize in one index. So an example, the largest example in Canada anyways, is the iShares Large Cap 60, that's maybe the second largest. It might be the largest, I forget. Anyways, the Large Cap 60 Index Fund, which follows the TSX 60 or S&P TSX 60, which is based on the top 60 companies usually by market capitalization on the TSX. And they trade, or this ETF trades on the TSX with the stock symbol XIU. So it seems weird because it's a stock symbol, but it actually isn't a stock underneath that. It's actually the ETF. And often you'll see that this particular ETF is amongst the top 10 securities traded, I won't say stock, but securities traded by volume on the Toronto Stock Exchange. So, some advantages of ETFs. They trade on a stock exchange, so they're very easy to purchase. You buy it like a stock, you put in the symbol, so that XIU if you wanted that particular ETF, but you find your fund's symbol and just buy however many units you want of that. And again, back to that mutual fund language, ETFs do trade in units, not shares, but neither here nor there. So another huge advantage of ETFs is with mutual funds, they always talk about comparisons to whatever underlying index is there. With ETFs, you don't have to beat the index because you're meeting the index. You're just buying the index. So for example, if you're looking at stock market activity, we often compare it to the TSX 60 or the TSX Composite or the TSX 300, one of those indices. Well, you don't have to compare anything because you're basically buying that index. The MERs, as I mentioned before, are very, very low. And I've said they're usually under 0.8%. Many are under 0.5%. You can even find some under 0.1% fee, MER, management expense ratio. So really, really cheap, especially compared to all of the active mutual funds out there, actively managed. Diversification, you can get a huge amount of choice, and there's over... I've said here 500 ETFs. You'll see later on there's actually way more than 500 ETFs. There's now thousands of ETFs listed on the Toronto Stock Exchange. And if you want to go to other stock exchanges, there's even more. And with that diversification, you can buy ETFs that are bond-based, and ETFs that are stock-based, and ETFs that are commodity-based, and on and on and on. And you can get different parts of the world covered and different sectors. So lots and lots of room for diversification. And if you're interested in Canadian content, you can get, what's nice is if you want to keep things local, you can still get global exposure while purchasing Canadian funds. So that's a neat thing that you can do with ETFs. And what's nice about ETFs is you don't have to worry about a fund manager. Fund managers with mutual funds, they don't last forever. Not to say they all die all over the place, no. But sometimes they just leave the funds or they get fired or whatever it is. And the fund changes, it fundamentally changes. Kind of a pun there, but it's true. ETFs, you don't have to worry about that because the picks for whatever underlying investments are in the ETFs are picked by the index itself. So they do change from time to time, but it could be a handful of times per year. It doesn't change that much. So no sense worrying about anything like that fund manager, which is you don't need that expert there. All right, disadvantages of ETFs. So they trade on a stock exchange. With stock exchange trading, you have to pay a fee. So with mutual funds, you don't pay a fee to compare. But with ETFs, you do have to pay a fee every time you buy and sell. Now, I say usually, personally, with the brokerage that I use, I won't mention them by name, but they start with a Q. Look them up. They're fantastic in Canada, of course. Whenever I've purchased ETFs, sometimes they charge $0, sometimes there's a special, but often it's really cheap. It's sometimes pennies. When you sell, it tends to be closer to the regular commission, $5 or $6, something like that. So you do pay fees, but they are a little cheaper than if you were just to buy stocks. Now, you should be buying in board lots, and a board lot's a minimum of 100 shares. So that could, and again, with ETFs, I think they do go easier on those kinds of rules, but especially with the fees. If you do buy under 100 shares or units, with a stock purchase, you'd pay very large fees for this normally. With ETFs, I think they go easier on that. There's a high startup cost. So if you do follow that board lot thing, to get some good diversification, you do need to spend probably a few $1,000s, at least a couple $1,000s to get started. With mutual funds, you can start with as little as 500, depending on the fund, of course. So diversification was an advantage of ETFs. Maybe it's a disadvantage. Maybe we have too much choice. So that's kind of a cop out there. All right, let's get into asset mix. Asset mix is, I'll give you a definition first and then tell you some factors that go into asset mix. So it's the percentage distribution, this is an official definition here, of assets in a portfolio collection of investments that you have among the three major asset classes, which are cash or cash equivalents, fixed income, and equity. So fixed income tend to be, generally speaking, bond-based investments. Equities tend to be stock-based investments, and you can throw commodities in there too, and other things. So it's basically what you have in your portfolio and how that is managed. Okay, so again, the definition is from Get Smarter About Money. Check them out. So with asset mix, to pick your own asset mix, there are two major factors you have to be concerned about. One is your time horizon. So how long are you making this investment for? Is it for a couple of days? Is it for a couple of weeks? Is it for a couple of years? Or is it for 40 or 50 years? Is this something that you're doing for retirement? So your time horizon, of course, it changes with your stage in life, and your asset mix will change probably over the course of your life. Generally speaking, the older you get, the more conservative you get, the less riskier investments you get. And that leads me to the next factor, which is your risk tolerance level. So you might be 18 years old and making investments, but you may not want, like I've met 18-year-olds that don't want any risk. They want to just invest in something that's either cash or very secure bond-based investments, and that's it. And that's fine. If you can't handle that risk, that is your choice, and that's perfectly fine, and that's up to you. So what I like to tell people, and it's not my invention, by the way, of course, it's out there a lot, but what you have to do with risk tolerance level is the sleep test. So if you make an investment and you are not comfortable and you're lying awake at night thinking, oh my gosh, I can't believe I just invested in this. This is really risky. I can't handle it. This big roller coaster. That investment is not for you. Okay. If you can sleep well at night, you have the right investment. And usually at this point in the class, I would tell a wonderful story about my dear friend and former colleague, pardon me, Mr. Watches, who he would come to me every day and he would say, oh my gosh, I just invested in this thing. It's great. It's fantastic. And then the next day he'd say, oh my gosh, it's down 10%. I don't know what to do. I don't know if I can retire now. And then you come in the next day and go, oh my gosh, it's up 5%. That's fantastic. And I would just look at him and I'd say, are you sure you're in the right investment? So it turns out that account that he was playing with, I found out afterwards, that was like 2% of his money. He was just kind of playing around, having fun. But he always seemed very anxious about his portfolio. And I would always tell him, you should probably pick a more conservative asset mix. Little did I know, until he eventually told me, he did have a very conservative asset mix. All right, so here's how you do diversification with asset mix. So, and as I said before, ETFs can cover many different industries, types of investments, countries, and so on. So, again, just to review, your asset mix is your mix of equities. We talked about this before. So you see this little this chart here. So what people would do is they would figure out what their ideal mix is depending on the person. So for instance, this person wants 60% equity, 30% fixed income, and then maybe some commodities and a little bit of cash in there too. So 5 and 5%. So that's that person's asset mix. So they're taking a bit of risk, but they also they're not 100% into equity. So in case something happens, like a very large economic downturn, their portfolios wouldn't be down as much because they have the safety of something like a fixed income investment in there as well. Now, going on, many advisors recommend at least 5% of your, or some small percentage should be held in cash. And the reason is that you have potential buying opportunities in there. So again, this all depends, and I'm saying this again, but there's a reason for it. It depends on your risk tolerance level and your age and how much time you have to invest. Now, there is a general rule of thumb out there that your fixed income, like if, all things being equal, your fixed income should be your age as a percentage, and then your equity should be whatever's left over. So for instance, if you're 18 years old, then have 18% fixed income, 82% cash, or maybe leave a bit in there for, or sorry, not cash, equities, 82% equities, not cash, and a little bit of cash there. So that's one thing. But what I would tell people is if you're 5 years or less away from retirement and you're going to depend on that money for your income, then most of your portfolio should be in fixed income, should be very safe. Maybe even instead of fixed income, maybe even more conservative, cash-based investments that pay, boring 2% interest, and you live off that and everything's great. Okay. The idea is that you don't want to risk losing your nest egg. There's tragic stories out there of people who were just about to retire. They had everything in one investment, and then that company went bankrupt and they lost all their money. You don't want to be in that situation. Okay, so don't put all your eggs in one basket. So here I have some examples of potential asset mixes based purely on age, and there's a few assumptions in here. The rough estimates don't include the cash, and very important, I'll talk about rebalancing in a second. And the fixed income age rule isn't really followed here. So we've got people under the age of 30. Generally, you could say, okay, their equity, you can take more risk. And this is especially if you're investing for the long-term retirement, for example. So 80% equity, 20% fixed income. Then when you're in your 30s and 40s, you might want to think, okay, maybe a little bit more conservative, 2/3 equity, 1/3 fixed income. In your 50s, 50-50. In your 60s, it flips from your 30s, 20-80. Then over 70, and this is assuming retirement age, maybe you're retiring earlier, 5% equity, 95% fixed income. Okay, and that could also be, again, cash or cash equivalent based investments. So you set that up and you have your portfolio. And then what happens is after a year, these numbers might change. If it's a good year for equities, maybe that 80 turns into 90 and the fixed income turns into 10. So what happens is you would then sell your 10% of your equity. So you sell high and then you buy your fixed income lower, because generally speaking, if the equity goes up, the fixed income percentage anyways goes down. Maybe not necessarily the investments. So when that happens, it again forces you to buy low and sell high. So you're selling this high and you're buying this low. Okay. So that is rebalancing. And it's really, really important to do that when you're doing this type of investment. You want to try and keep your investments at these levels. If it's 80-18, maybe leave it for another year and see what happens. Okay. So how do you actually make an ETF investment? Well, there's that Q brokerage. You need an account with a broker, something like the ones I mentioned here, iTrade, Questrade. There's, banks have them now, and there's lots of them. These brokerages usually need at least $1,000 as an initial investment, so that's the barrier to entry there. Mutual funds, you can start a lot lower, and of course you have to be 18. You have to be able to sign a contract. And once you've satisfied all the above, you would buy and sell ETFs like a stock. Now, of course, when you get a brokerage account, you should read through all the fine print. I know when I got my account, it was 18 pages of fine print, but I read all that because that's what I do. All right. Now, ETF providers in Canada. There are many, many, many providers out there. Now it's over 20 companies. ETFs are relatively new, by the way. They're probably, at least as far as popular investments, 20 or less years old. So 10 years ago, there was something like 4 ETF companies. So now there's a whole bunch. There's well over 20 companies offering over 700 ETFs on the Toronto Stock Exchange. That's just in Toronto. And that is based on me looking just a couple days ago at that, in May 2020. All right, finally, your couch potato strategy. So you've been waiting for this. Oh, and I'm sorry it's going so long. I just looked at the time, but it's kind of important. So you got all this information, this ETF information. How do you put it to use? How do you create your ideal asset mix? Well, the wonderful people at Money Sense magazine, pardon me, Money Sense is, well, when it was published in paper, it was my favorite magazine. Now, it's still available digitally. So what happens is you pick a few ETFs and you make a target asset mix, and with about 3 or 4 or 5 investments, you've got your asset mix covered, you got diversification covered, and it's so simple. So here we go. So here's some examples. There's the classic couch potato, which is 1/3 Canadian equity, 1/3 American equity, and then 1/3 Canadian bonds. So this would be a 67% equity, 33% fixed income, equity versus fixed income asset mix. Now, the global one has 20% equity, Canadian equity, 20% American equity, 20% European, Asian equity, equity from some other part of the world, we'll say. You could just get international equity as well, which is many, many countries. And then 40% bond, so Canadian bond. So this seems like, we got so much more exposure in other parts of the world, but it's actually a bit more conservative than the last one because this is 40% bond or fixed income and 60% equity. Whatever you choose, and you can mix and match this and pick however you want. Whatever you choose, it's very important to rebalance your portfolio at least or once a year. It doesn't have to be 5 times a year. Rebalance the portfolio so you still maintain these percentages, whatever these goals are that you have. This 67-33 split or whatever it is. And again, I haven't accounted for cash here, but rebalancing is very important. So if you're really interested, I believe I still have a copy somewhere of Money Sense's Buyer's Guide to ETFs, or just look it up. I think it's still available online somewhere. It's from a few years ago, but great article. So I'm Mr. Goldberg. I hope you enjoyed, and there are my wonderful works cited, and we'll see you soon.